In this video, I'm going to talk about the Procter Gamble earnings report that was released last week. The main thing I want to talk about is the conference call, actually, from Procter Gamble. I'm not going to go through the entire earnings conference call. That would take too much time. Their conference call was over an hour long. But I've read through their earnings conference call and I've gleaned the most important information from that. I've highlighted and snipped out the most important information, so I just want to talk about that. And it's actually this information from the earnings conference call that I want to talk about isn't just all of the inflationary supply chain labor issues from the past year. I mean, there is that, obviously, but there's some more important stuff that I want to talk about on their earnings conference call. But before I talk about that, I want to talk about their actual financial release. I'm just very briefly going to talk about their financial release. All right, so let's get started talking about that. And actually, okay, so, well, before we do that, let's just do a very quick reminder of their product portfolio. So here we are right here, right? So Procter & Gamble, right, of course we're talking about, right, they're the world's biggest consumer staples company. And, right, so a reminder of their portfolio, right, they're the owners of Tide, Aussie Shampoo, Vicks Vapor Rub, Always. So I'm not going to read this entire thing, but, right, the biggest ones, Head & Shoulders, Pringles, Bounty, Crest, Downy, right, Tide, Always, Pampers, Bounty, Gillette, Charmin, Oral-B. Right, so, yeah, very big consumer staples company. They have some of the biggest consumer staples brands in the world. They're a multinational company. So let's talk about their financials first in the release. So first of all, right, they beat, right? So the estimated revenues was 18.73, but they achieved 19.4. So they beat revenues by 4-5%, and they beat EPS by more than 2%. So they beat on both the top and the bottom line. And we can actually see, this is their 10Q right here, their 10Q report. So right here, this is their March quarter. All right, and also something I just want to say now, because it'll probably come up again in this video, that right here, so their release for the January, February, and March quarter, that was Procter & Gamble's fiscal third quarter of 22. So even though it's the calendar first quarter of 2022, Procter & Gamble's fiscal year is 2 months ahead, right? So yeah, kind of weird, but January, February, and March is actually Procter & Gamble's fiscal third quarter. So I just wanted to mention that now because that's, I'm sure, gonna come up again in this video. And yeah, so for the 3 months ended March 31st, right, so this isn't their beat, of course, right, because these aren't the consumer estimates. This is just their earnings from this time last year. So they beat revenues by 7%. But look at this. So yeah, this is something that I wanted to point out because this is something that's very, very normal for an inflationary environment. So they beat revenues by 7%, but their gross profit actually decreased by 1%. Right, so the gross profit, right, we're just talking about the revenue after cost of goods sold. Right, so yeah, you can see here the cost of products sold increased by 16%. So yeah, their gross profit decreased by 1%. Right, and this isn't their gross margin decreasing by 1%. That'd be bad enough. This is their actual gross profit. Well, you can actually see the gross margin down here. So the gross profit percentage, or the gross margin, right, decreased from 50.7 to 46.7%, right? So 4% or 400 basis points. So that's quite a big decrease, right? A really big decrease. But actually, they offset that because their SG&A expenses, they decreased. So this isn't their operating income, right? We're talking about their SG&A expense, their selling, general, and administrative expenses. They decreased that by 3.8% or 380 basis points. So actually, yeah, they kind of offset their decrease in their gross margin. So their operating income right, or their operating income percentage or their operating margin only decreased by 0.1%, right, 10 basis points. So their total operating income, we saw an increase right here, 60% increase. And then, okay, back down to the bottom line, their net earnings increased by 3% and their EPS increased by 6%, right? And the reason for this right here, this discrepancy, is just because their share count decreased by quite a lot. They bought back a lot of shares out of the past year. So because of that, even though their earnings only increased by 3%, their earnings per share actually increased by 6%. So they had an increase from last year, and they beat expectations. So yeah, I mean, their expectations were for them to increase their top and bottom line from last year, and then they beat those expectations. So good for them, right? All right, so, and this is just digging a little bit more into the financials, and then I'll get to their earnings conference call. So their organic sales growth increased by 10%. Right, so, well, hold on. Just a reminder, we can see right here, right, their sales growth increased by 7%. Their organic sales growth increased by 10%. And what this means, organic sales growth just means basically sales growth, but sales growth not including any impacts from any acquisitions made, right? So, right, over the past year, if they have any sales growth or sales decreases because of any acquisitions over the past year, right, that would be included in their total sales growth, but not organic sales growth. So organic sales growth is just sales growth internally, basically, just from the main core company without any acquisitions, right, or without including any of the impact from acquisitions over the past year, right, and then organic. Again, organic volume growth. So volume growth is just basically unit growth. You can think of it like unit growth, right? So they actually, right, you can see that their organic volume growth, so their organic unit growth, only increased by 3%. So if they only sold 3% more products, well, how did they achieve 10% more sales? Well, because they were selling those products for a higher price, right? And we'll talk more about that in a second. So, and then, right, like we said, their EPS growth increased by 6% right here. So that's what this is, their core EPS growth. And actually, so just a really quick accounting lesson. I don't want to get too deep in the weeds here, but when they say core EPS growth, they just mean their non-GAAP EPS growth, right? And actually, so companies normally, not always, but they normally get their GAAP EPS and their non-GAAP EPS. And when they get their non-GAAP EPS, they don't necessarily call it their core EPS, but that's what Procter Gamble does. This is something that is up to the company's discretion. They're just calling their non-GAAP EPS their core EPS. So how is GAAP different from non-GAAP? Well, non-GAAP and GAAP are different in there are many different things that can differentiate GAAP and non-GAAP. Right, but for Procter & Gamble, we're normally talking about restructuring charges or, early debt extinguishment or something like that. So, right, normally restructuring charges or early debt extinguishment are expensed in the income statement. And so normally, right, restructuring charges or early debt extinguishments would have a negative impact on EPS. But when they're reporting something like core EPS, they're just basically saying what their EPS would be without these restructuring charges and early extinguishment of debt charges, because they feel that it's not something that really affects the company, right? It's not something that they feel that many investors should really use to analyze the company's growth. So they just report core EPS. So basically, yeah, that's their non-GAAP EPS, or their EPS without restructuring charges, without their early debt extinguishment. But actually, it's kind of funny because over the past, like right here in the past quarter, it's a moot point because, right, well, the core EPS growth increased by 60%. Their EPS growth increased by 60%. So, yeah, and well, I've read through this 10Q, and over the past quarter, their core EPS and their EPS is the exact same. They did not have any restructuring charges or early debt extinguishment charges over the past quarter. So, yeah, right. Core EPS growth and their EPS growth were the same over the past 3 months. Anyway, their currency neutral core EPS growth. So again, currency neutral core EPS growth. We're just talking about, how do I say this? So Procter Gamble earns a lot of the revenue outside of the U.S. And as the dollar strengthens, that would have a negative impact on any of their operations outside of the U.S., right? Because say they earn some revenue in Germany, say they earn 2 million euros, right? So if they earn 2 million euros in Germany, right, well, obviously they're going to have to bring that money back over to America and exchange that money to US dollars. And when they do that, well, the weaker the dollar is, the better, right? Because the weaker the dollar is, that means the more dollars they're going to be able to get for the euros, from the euros that they bring back from Germany, right? But over the past 3 months, the dollar has been getting stronger and stronger and stronger. So, right, that means that any money that they bring back from Europe, I mean, just using Europe or Germany as an example, but really this goes for anywhere over the world, right? Any money that they bring back to America is going to be worth less the stronger the dollar is. So they're basically saying currency neutral. They're basically saying that if the dollar hadn't strengthened over the past 3 months, what would their core EPS growth be? And the answer is 10%, right? So yeah, 10% core EPS growth, 10% organic sales growth. So growth on the top and the bottom line. So a very strong report. And then free cash flow productivity, I'm not going to talk about that much in the video, but for free cash flow productivity, they're just talking about the free cash flow as a percentage of net income, right? Because really, I mean, everything held equal in a perfect world, you would want free cash flow to be more or less equal to net income. And, well, we can see it. So their free cash flow is a bit less than their net income for this past quarter. But normally, within a given year, their free cash flow is normally the same as their net income. And I'm not going to go too deep into that in this video just because I really want to get to their conference call. But yeah. And then really quickly, there were organic sales growth. So that increased by 10%. Their volume growth increased by 3%. And there's a bit more detail right here. So you can see, yeah, here it is, right? The thing that I talked about earlier, their third quarter earnings report. So, right, we're talking about calendar year quarter one. So January, February, and March. So that's their fiscal third quarter. So their organic growth increased by 10%. Pricing, so yeah, volume contributed 3 points. Oh, man, let me get this out of the way. So volume contributed 3 points, right? Pricing contributed 5 points. So yeah, part of the reason for their such high increase in their organic sales growth was because of pricing, right? Not just because of volume, right? They only sold, well, as we saw in the last slide, they only sold 3% more products from this time last year, right? But part of the reason that organic sales growth was so high is that they, their prices were higher. And then here's something I want to talk about. Mix added 2 points to sales growth. So what does mix mean? So when we say mix, well, their product mix, we're basically talking about their product portfolio. So changes in their product portfolio. So basically what we're saying, mix added 2 points. So we're basically saying that people are trading up within their product portfolio, right? So like say people bought cheap Procter Gamble. So, well, okay, just keep unit growth constant. So if we're just talking about mix here and keeping everything else constant, we can say that, say somebody bought 5 Procter Gamble products, right? And then they switched to buying 5 more expensive Procter Gamble products, right? But that wouldn't go into pricing, because pricing, we're talking about like an increase in price of the same product, right? And we're not talking about that here. We're just talking about if they say they're buying like a very cheap Procter Gamble product, right? Very cheap Procter Gamble diapers, right? But then they buy more expensive Procter Gamble diapers, right? So that would obviously add to Procter Gamble's sales growth, but it wouldn't be in pricing, because again, pricing, we're just talking about higher price for a given product, right? And it wouldn't be volume, because they're not buying more; they're buying the same amount. They're just buying a different product in Procter & Gamble's product portfolio. So yeah, so 10% organic sales growth, but yeah, you can see right here 7% sales growth, right? Yeah, 5 either price, volume 3, and then mix 2 for organic sales growth. And again, yeah, just to say one more time, the reason that organic sales growth is different from the total sales growth is because organic, think about what that means. That just means that without any acquisitions, or without any impact of sales from acquisitions. So we're just talking about the internal company sales growth, like the actual like organic. Well, think about what that means, right? So yeah, and one more thing. Okay, yeah, and so yeah, I promise I'm going to get to the earnings conference call really quickly. So yeah, this is just their guidance for the full year. So they increased their organic sales growth outlook to 6 to 7%, and they increased their all-in sales growth. So all-in sales growth, we're just talking about sales growth, basically, right? We're just talking about total sales growth. So they increased their total sales growth outlook, and they increased their organic sales growth outlook. And okay, and that includes a 2% negative impact from foreign exchange. So I've already talked about that. So obviously, they're assuming that the dollar is going to continue to strengthen, because, well, they think it'll have a negative impact on their sales growth. And then their earnings per share growth. So we talked about core EPS and EPS, but they maintained their core. So when I say that they increased their growth outlook or maintained their growth outlook, I'm talking about from the previous quarter. So the previous quarter, they gave their full year 2020 guidance, full year 2022 guidance, right? And so they increased their guidance for sales, but maintained their guidance for core EPS and all-in. So all-in EPS, we're just talking about GAAP EPS, right? Their actual total EPS. So yeah, they increased their sales outlook, but maintained their EPS outlook. And that's kind of a similar situation as what we saw right here, right? Basically, right, just margin compression is all that this means, right? So if they're increasing their sales outlook, but their EPS outlook is remaining the same, then obviously they're factoring in margin headwinds or a decreased margin. So margin compression. And we saw that right here, margin, because, right, well, I mean, yeah, definitely margin compression in their gross profit, but especially in their gross profit, but even after, a little bit of offset by decreasing their SG&A expense, we still saw a little bit of margin compression in their net earnings, but not too bad because of their lowered SG&A expenses. So, yeah. All right, now on to their, well, actually one more thing before I talk about their earnings conference call. So this right here, so I took a screenshot of the estimates for this quarter, next quarter, and next year before they released their earnings report. And yeah, so like I said, they beat, right? So, right, they had a beat, 4 to 5% beat on revenues, then like 2.5% beat on EPS. And of course, this is a bit different. This says their expected EPS for the March quarter was 1.29. This is 1.3. But I mean, they're different websites, right? But the reason I'm talking about this is because, all right, well, they beat, right, on both the top and the bottom line. But now look right here. So, and again, this picture was taken before their earnings was released last week, and there were actually estimates for the June quarter. So that would be Procter Gamble's fiscal fourth quarter. There were estimates for that, right? And the revenue estimates were 19.41. And then what we can do, we can look and see whether those estimates are now, like they're the current estimates. So now that their earnings report for third fiscal quarter has been released. So before the report was released, the revenue estimates for the fiscal fourth quarter were 19.41, right? And now they're 19.49. So, right, revenue increased. And now look at this. Their EPS estimates were 1.29. And now the EPS estimate is 1.25. So, right, right, and I said that, look, so for the year, they said that they increased their revenue outlook, but they maintained their EPS outlook. And you can actually see right here. So for the full year, right, before the report, there was an estimate of 5.85, and there still is, right? Before the report, the revenue estimates for the full year were 79.42, and now it's 80. So yeah, I mean, accordingly, with the company's own estimates, the analysts are now estimating that the revenue for the full year will increase and EPS will stay the same. But interestingly, for next quarter, analysts are now estimating that EPS will be, right, because originally they thought 1.29 for fiscal fourth quarter, now they're thinking 1.25. But they, like we said, they increased their revenue estimate from 19.41 to 19.49. So yeah, now analysts are thinking that for next quarter, Procter & Gamble is going to have a higher revenue than what they were thinking, right, before their, analysts are now thinking that Procter & Gamble will have a higher revenue for their fiscal fourth quarter compared to what analysts were thinking before Procter & Gamble released its third quarter earnings report. But they think that their earnings per share will actually be less, right? So actually, you can look down here. This is actually simpler. So, right, EPS trend. So 7 days ago, so before the report was released, analysts thought that Procter & Gamble would have an EPS of 1.29 for the fourth quarter, and now they think it's 1.25. So yeah, analysts' revenue estimates for Procter & Gamble for the fourth quarter increased, but their EPS estimates decreased. Right, but for the full year, their revenue estimates increased, but their EPS estimates stayed the same. When I say there, I'm talking about the analysts. All right, so all of this is just what you would expect for a staples company, or really most companies in an inflationary environment, right? So more of this, what we saw over here, more of the same. All right, so without further ado, now I'm going to talk about the earnings conference call. I'm finally going to talk about Procter & Gamble's earnings conference call. All right, so let me go to this. Here we go. And remember, like I said, I'm not going to go through their entire earnings conference call. That would take too long. Their earnings conference call lasted for over an hour, so I'm not going to read through the entire thing right here. And remember, well, like I said, I read through the entire thing, and I just took out the most important quotes that I wanted to share. So we have 21 right here. So I say 21 pictures, and I'm just going to go through those quotes really quickly. And they're what I feel are really the most important takeaways from their earnings conference call. And so here, let me add myself back in here. And yeah, so one more thing to point out. I mean, obviously, most of these quotes are just more of the same from anything that we've gotten over the past year. So things about inflationary pressures, supply chain issues, margin compression, labor costs, right? But these do give a little bit more color on the unfolding situation, on what things are like currently, how they're affecting the company, how they've affected the company over the past 3 months, or in January, February, and March, right? I mean, obviously, the company is going to talk about that, but there are some other stuff here as well that's kind of interesting. So let's start right here. So, yeah, they're just talking about the markets, but they say, this is interesting, Greater China organic sales were down mid-single digits. versus a comp period that was up 22%. So yeah, even though the total revenue of the company overall was up in their fiscal third quarter, January, February, and March, Greater China organic. So we're talking about organic sales too, right? So remember, the total organic sales for the entire company was up 10%. But Greater China organic sales were down mid-single digits. But it looks like, well, part of the reason, right, it says right here, last quarter, or not last quarter, but their fiscal third quarter of last year, Greater China sales were up 22%. So they were lapping that very high growth period. But also, I mean, this is kind of a concern in and of itself. And we can think part of the reason I'm sure is they were lapping a very strong growth period, but also, well, potentially the lockdowns that have been going over there, the stalling growth that we've been seeing in China over the past 3, 4, 5, 6 months, even though this is only for their fiscal third quarter, January, February, and March. But anyway, something else right here. So they're talking about the market shares. Yeah, global aggregate market share increased 50 basis points. 36 of our top 50 category country combinations held or grew share for the quarter. So, yeah, this just points to the dominance of Procter Gamble. That in this kind of tough time, this inflationary time, they're actually growing their market share. So yeah, I guess when times get tough, when things get more expensive, people really, go to the brands that they know, go to the brands that are really reliable. So they actually grew market share by 50 basis points. 36 of our top 50 category country combinations held or grew. Yeah, so they grew market share in most of the countries that they operate in. And right here, so higher commodity and freight cost. Okay, so this is just more of the same. Higher commodity and freight cost impacts combined were a 490 basis point hit to gross margins. And so their overall hit, right, we saw was 400 basis points. So from this period last year, their gross margin decreased by 400 basis points, or 4%. They're saying 490 basis points of that hit was just from commodity and freight cost impacts. And then mix was 130 basis points, was a 130 basis point headwind. And remember what I was talking about, mix is just basically people changing what they buy in Procter & Gamble's product portfolio. Pricing and productivity savings of 260 basis points partially offset the gross margin headwinds. So they had a positive impact from pricing and productivity. But, right, the main thing here that I want to talk about, higher commodity and freight cost impacts combined were a 490 basis point hit. So yeah, that's the most important thing right here, right? 490 basis point hit. That is a lot. That is a big hit from commodity and freight cost impacts. So yeah, I thought this was interesting because they're not just talking about commodity and freight costs having a negative. Oh, my camera just died. Or did it? All right. Well, anyway. Yeah, higher commodity and freight cost impacts combined. So, yeah, very big. Well, you know what? So anyway, like I was saying, they didn't only talk about the negative impact of commodity and freight costs, but they actually gave a number. They actually gave the actual number of the negative impact of those costs. So yeah, I thought that was pretty interesting. All right, and right here, so noticeable superiority is perhaps the most important thing in the inflationary environment we are potentially facing. So yeah, superior offerings delivered with superior execution drive market growth. This drives value creation for our retail partners. Yeah. So this is just them talking about kind of what I was saying before. I think in one of the previous slides, I think it was slide 2, right? Right, yeah, talking about how they increase their market share, right? So when times get tough, right, superiority is really the most important thing, right? That's really what gives a company pricing power to help them really thrive in the inflationary environment. And then here are the recent spikes. The recent spike in virus cases in China are, let me put myself back. The recent spike in virus cases in China and resulting lockdowns are affecting consumption and have caused temporary work stoppages in our operations and those of our suppliers. Right. So earlier, right, remember we had that slide about how their growth, their organic growth in China was actually down from this time last year, right? It's down from this time last year, right? And so not only do we have to worry about their growth being down in China, but also think a lot of their supplies are made in China, right, and shipped out of China. So that's affecting them, right? So they're actually this stuff going on in China isn't only affecting Procter & Gamble on the demand side, but also on the supply side. And obviously this is true for a lot of companies, not just Procter & Gamble. But yeah, Procter & Gamble, here they are talking about it. So it's obviously, affecting them to a degree. We've seen continued cost increases in nearly every type of material we use, and in diesel and natural gas, freight costs have continued to increase. So I'm not going to talk too much about that. That's just more of the same that's been going on for pretty much a year now. So the feminine care business has announced, oh yeah, right. Okay, so here's something that, arguably the most important slide that I want to talk about. The feminine care business has announced an additional price increase in the US, which will be effective in mid-July. Also, as a result of these increased cost headwinds, we recently announced price increases on certain items that will be effective at the end of June. And in the US oral care business, that will be effective mid-July. Right. So basically, right, I mean, the reason why I think this is so eye-opening is because, right, I mean, we all know that over the past year, there's been an insane amount of inflation. And, right, they're saying that, well, I mean, they have been increasing prices over the past year, but, well, they're not even done yet. And actually, they have price increases that not only haven't gone into effect yet, but they're not going to go into effect for another couple of months. So not until June, in mid-July. And we actually saw this kind of thing in a lot of earnings reports from last quarter, right? So we're talking about earnings reports that were released at the end of January. So at the end of January, a lot of companies came out and they said on their earnings conference calls that they were putting into effect. They were putting price hikes they were putting into place price hikes that would go into effect in March or April, right? So this was back in January, right? We were already seeing a lot of inflation back then, and then a lot of companies were saying, oh, well, we're going to put in place these price hikes that will go into effect in March and April, right? Well, here they're doing the same. We're seeing more of the same. Right, companies are saying that not only have they already put into place a lot of price hikes, well, they're not saying that, but we know that they've already put into place a lot of price hikes. I mean, over the past year. But yeah, now we're seeing more that haven't even taken effect yet. Right, they're not even going to put these price hikes into effect until June or July, and we've also seen a lot of similar quotes coming out from companies over the past couple of weeks. And like from Conagra or Kimberly-Clark, which are two other consumer staples brands, right, that have released earnings reports over the past couple of weeks. And I've actually read through their conference calls, and I'll do another video on them. But yeah, Conagra said the same thing, that they put into effect price hikes that aren't going to take effect until June or July, right? So yeah, kind of scary. There is no end of inflation in sight, or at least not yet. So far, yeah, and okay, this is something that is also very important. So arguably one of the other most important slides. So far, elasticities have been in line or better than our expectations. So if you're not familiar with economics, or you're not familiar with what this means, right? If a price is very elastic, that means as price goes up, then demand will go down, right? Which really, I mean, you would expect that kind of thing in economics anyway. And what I mean is that the core economic principle is that, of course, as price goes up, demand will go down. But the thing is, the more elastic a product is, the more that will hold true. So if a product is very elastic, then when price goes up, demand will go way down. But if a product is very inelastic, then if demand goes up, then demand won't go down, right? And obviously, I mean, no product is perfectly inelastic, but they're saying that the elasticities have been in line or better than our expectations. So, they're of course not saying that their products have been more elastic, because really business wants their products not to be elastic, right? If they raise price, then demand won't go down, right? Or at least won't go down very much. And so they're saying that their elasticities have been better than they expected. What they mean is that they've been raising prices, but demand hasn't been going down as much as they thought it would, right? So that just shows that, so we saw last slide, they're going to put in place more price hikes, and we can see from this slide that the current price hikes that they put into place hasn't really affected demand that much. So people are putting up with it. Basically, people are putting up these price hikes, and there are going to be more. On the bottom line, we're maintaining the core earnings per share growth range of 3 to 6%, and we saw that, right? Where is it? Yeah, 3 to 6% for core EPS growth, and we talked about what that means. But given cost challenges we're facing, we now expect to be at the low end of the range of 3%. So, right, okay, I guess in the slide they didn't update their guidance, right? But they kind of are updating their guidance, because now on the conference call they're saying so here, I'm going to close that. So on their conference call they're saying that they're probably going to be at the low end, right, of that 3 to 6% range. So they kind of are lowering their guidance. And so now that makes sense, what we saw right here, right? Because we said that, I guess for the full year, analysts they haven't really changed their expectations that much. But anyway, within this guidance, we expect an additional 4 cents per share of negative impact in the fourth quarter from higher costs and limited operations in Ukraine and Russia. All right. Okay, my camera is lagging now, so I'm going to turn it off. And it won't go off. Oops. All right, there we go. All right, so our initial guidance in July assumed 1.8 billion after tax, the impact from commodities, freight, and foreign exchange has increased significantly since the start of the year. So again, right, foreign exchange, I've talked about this. So we're talking about a stronger dollar. A stronger dollar hurts the profits or even the revenues of Procter Gamble, right, when they bring those revenues back from foreign countries. So yeah, the impact of commodities, freight, and foreign exchange has increased. Our initial guidance in July assumed 1.8 billion after tax. This increased to 2.3 billion in October and 2.8 billion in January, now with 3.2 billion after tax headwind. So yeah, this really sums it up, like how bad, how things have been getting worse and worse and worse and worse over the past year. Because even in July of last, so 9 months ago, there were 1.8 and then 2.3 of additional 2.8, or 2.3, then 2.8, and now 3.2 billion of additional after-tax headwinds, right? Or I guess, yeah, 3.8. So 1.4 more than what they were initially assuming. So on an EPS basis, the headwinds are now approximately 1.26 a share, or a 22% headwind. So in the face of an incremental 56 per share of negative cost impact since the start of the year, we've held our going in EPS range, and we've maintained strong investment superiority with new product innovation and fully funded advertising programs. So, right, so we can see, right, 1.8 to 3.2, that's about an 80% increase. And so right here on an EPS basis, they're saying the headwinds are now 1.26, and okay, that's up from 0.7, right? Because they're saying it's increased by 0.56. So initially they were assuming that it was a 0.7 EPS headwind, and now they're assuming a 1.26 EPS headwind. So yeah, that's increased by about 80%. So yeah, so it's been getting worse and worse and worse over the past year. And then again, so yeah, this should wrap up pretty quickly, because everything from here on out, I think, is just kind of a reiteration of what's already been said. So elasticities are better by about, so yeah, they've already said elasticities are better. Now they're giving a number, they're putting a number on it. Elasticities are better by about 20 to 30% versus what historical data would have indicated. So yeah, elasticities. And again, when they say elasticities are better, they're talking about more inelastic, right? I mean, better for the company, right? Because the more inelastic the product is, the better that is for the company. So yeah, better by about 20 to 30% versus what historical data would have indicated. So yeah, better than elasticities, or things are more inelastic compared to what they were in the company's history. And then, oh yeah, okay, and then this is just an example of the product mix, something that I talked about earlier in this video, right, when I gave an example about the product mix. So product mix is basically just moving up or down in their product portfolio. So on diapers, we have multiple offerings, starting with Pampers Pure at about 40 cents a diaper, Swaddlers at 35 cents a diaper, Baby Dry at 30 cents, and Loves at 20 cents. So yeah, so they have their high premium diapers, Pampers Pure, and then their lower end diapers, their Loves. So that's just an example of their product mix. And then this will come back up in a minute. A lot of the price increases that we've announced are yet to flow through. Okay, well, we already saw that, right? Because a lot of their price increases are going to be put into effect later on this year, so in June or July. So yeah, these price increases have yet to flow through. With innovation, we'll try it at a very granular, so you'll see an incremental. Also this means that even maybe if they've already put into effect some price increases, like in January or February, right? I mean, right, obviously they wouldn't really have seen that much of a revenue effect from that yet, right? Which would result in margin headwinds, a margin decrease, which is what we have seen, right? Remember, we saw that their gross margin decreased by 4%, from this time last year. So yeah, and the reason for that would just be, well, yeah, they haven't really seen a lot of effects from the price increases that they even have already put into effect. But obviously they've seen the cost increases from all the increased commodity and freight costs. And then this, again, is about China. The lockdown had two impacts in China for us. One on the supply side. Yeah, and this is what I was talking about, right? There's kind of a double effect, right? Because you have the demand being lost. And then, yeah, on the supply side, we have two plants in the Shanghai area and the contract manufacturer. So, blah, 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 and we're certainly seeing a significant impact in terms, and we're certainly seeing a significant impact in terms of consumer demand. So, right, they're getting it on both ends, right, the supply side and the demand side from the shutdowns that are going on right now in Shanghai. And this right here is something that I've been pointing out since the beginning of this video. It says, so we see consumers trading up even within our portfolio into higher performing product propositions. And this really goes back to this right here, right? So remember, I was talking about how they've had 10% organic sales growth over the past quarter. And I said that part of that was because of volume growth, right? Volume growth means that selling more units, right? We talked about that. Part of that was pricing growth, so more expensive products. Then the final part of that was pricing mix, right? So it says added two points to sales growth. And remember, I said pricing mix was basically just this right here, right? Consumers trading up within the product portfolio. And they even give an example back here that I pointed out, right? They give an example of their product portfolio. So, and just for an example of moving up within the portfolio, right? Well, we have Pampers at 40 cents per diaper and Love's at 20 cents per diaper. So, right, so let's say that somebody bought 1 pack of Love's per month, right? And now instead of buying 1 pack of Love's per month, they buy 1 pack of Pampers Pure per month, right? So they're not changing the quantity that they buy. They're just moving up within the portfolio. So now they're buying more expensive products within the portfolio. And then this right here is just kind of the opposite, right? I mean, the same thing in saying the same thing in kind of an opposite way. If you look at private label shares as a proxy for trade down, they remain below a year ago in the US for the past 3, 6, and 12 months. And what private label is? So a private label brand is pretty much a good that is manufactured for and sold under the name of a specific retailer. So basically a store brand, for lack of better terms. I mean, it's basically a store brand, right? So it wouldn't be something like Procter Gamble, right? It wouldn't be Pampers or Huggies or something like that. Well, Huggies on Procter Gamble, but it wouldn't be something like that, like a well-known brand. We're basically talking about like a store brand. And they're saying that if you look at that kind of thing as a proxy for trade down, it remains well below a year ago in the US for the past 3, 6, and 12 months. And then this right here is pretty much just, remember at the beginning of the video, I said that a lot of what Procter & Gamble is saying, or a lot of what a lot of companies are saying, is just more of the same over the past year, right? So it says, supply constraints are only present in every potential bucket that you can think of. Being able to source being able to source raw and material, I guess I mean being able to source raw materials, is still difficult in sufficient quantities. Getting raw and packed materials to the places we need to get them to continues to be costly and highly volatile. Labor availability is certainly stretched, not for P&G directly, but more for our supplier base. So right, like I said, more of the same. Supply constraints, labor issues, product costs. All right, and then this just sums up one more time what I've been saying a lot, what I've been reading off a lot, that we've seen consumers continue to trade up within the P&G brand portfolio in higher premium positions. But the thing is, the reason I even included this quote right here, right? Like it says, every quarter this fiscal year. And keep in mind, remember I said their fiscal year is different from the calendar year. So the quarter that they just reported was for the third fiscal year, Procter & Gamble's third quarter fiscal year, or for their, fiscal year third quarter. So their fiscal year actually started in June, April, May, June, July, actually. So July 1st, right, of last year. So they're basically saying that ever since July 1st, 2001, they've been seeing consumers trading up ever since that time. So that's how much money people have had, right? That's how willing people have been to spend and trade up. There are a lot of mileage benefits. So right here, they're basically saying that they want people to understand that just because a certain product in their portfolio is more expensive, it doesn't necessarily mean that it's more expensive per usage hour usage. Basically that they're saying that their more expensive products are more efficient, right, is a better way to put it, that their more expensive products are more efficient, and they want people to understand that. And they actually have a pretty cool example right here, and right, this this wasn't totally necessary to point out. I just thought it was a kind of cool example. So here, I'll read it off. A great example is the formula innovation we've launched on Tide and Ariel laundry detergents to enable superior cleaning performance in cold water washing. We are strengthening the communication of the cost benefits to consumers and the environmental benefits for the planet on the package and in our advertising. For consumers, the savings from switching from hot to cold washing can nearly offset the cost of Tide or Ariel liquid detergent in each load. So they're basically saying that if people buy more expensive detergent within their portfolio, then it can actually help offset some of the cost of that product being more expensive, because that product is a lot more efficient than some of their lower end products. So they're saying that they want people to realize that, but apparently, getting people to trade up within their product portfolio has not been a problem for them over the past 9 months. And this right here. So remember, I was talking about the product elasticities for Procter Gamble, but right here they're saying, we do not assume the favorable price elasticities to hold. In our forecasting, we assume price elasticity is to return to normal levels that we've seen historically, right? So basically, the price elasticities we're talking about, well, Procter & Gamble is raising prices, but they're not really seeing demand really go down that much, if at all. But they're saying they don't expect that kind of thing to continue in the future. So, I don't know, maybe they're right about that. We'll see. All right, well, that's it. So, basically, I know this video was kind of long, but I thought that this was a very interesting earnings conference call, a very interesting earnings report. Actually, in my opinion, the most interesting earnings report so far this earnings season. So just to sum up, the three main takeaways from this report, and I mean, the reason I think that they're so important is because these takeaways are not company specific. They're just takeaways that not only affect every consumer staples brand, but really every company in the economy, right? Something that probably every company in the economy is seeing right now, or seeing or doing. So number one, the price hikes that the company, that Procter & Gamble has put into effect, but have yet to flow through. So remember, I was talking about, I showed that slide where they said that they're going to put into effect some price hikes that will take effect in July, right? Or they've basically announced price hikes that won't even go into effect until July, right? And a lot of companies have done that kind of thing. And I'll talk about that more in subsequent videos. But yeah, so they've put into effect some price hikes that haven't even flown through yet. So we haven't even seen them yet. And then number two, right, when they talked about the elasticities, the price elasticities, the favorable price elasticities. So basically how they're seeing very inelastic demand, how they're raising price, but consumers that's not really affecting demand. They're raising price, but they're not really seeing that much, if any, decreased demand from that. And that, again, is something that is affecting a lot of companies, not just Procter & Gamble. And then the third thing is that consumers are trading up within the Procter & Gamble product portfolio. So they're buying more expensive products in the Procter & Gamble product portfolio. Right. So yeah, that just goes to show how much people are willing to spend money. So for one, right, Procter & Gamble has been raising prices over the past 9 months, and they're going to continue raising prices. And the thing is that that's not even affecting demand. So demand isn't even going down. People are continuing to demand these products, very, very inelastic demand. And not just that, not only are people not reducing their demand in the face of increased prices, but they're actually moving up within the product portfolio. They're buying more expensive things in the product portfolio. So that just goes to show really how well off the consumer is right now, how much, or at least how well off financially the consumer is right now, and how much money the consumer has. Anyway, and yeah, and these three things, so the price hikes that have yet to go into effect, seeing inelastic demand, and then having consumers move up within the company's product portfolio, this is something that is affecting a lot of companies in the economy. And it was actually something that has been mentioned in quite a few earnings reports so far this earnings season. And I'm going to talk about that in some future videos. And anyway, well, I know this video was kind of long, but like I said, I thought this earnings report was very, very interesting, and actually, in my opinion, the most telling and the most interesting report so far this earnings season. So anyway, yeah, I know the video was kind of long, but hopefully you learned something. Thank you for watching, and take care.